Hi, this is Nathaniel Pulsifer with Wholesale Income Advantage, and I wanted to take a minute to highlight a specific case for you that's just a fabulous deal available right now. This case may not be available when you see this video, but this one really illustrates how the wholesale income program works and how it can just beat the pants off of a regular 60-40 stock and bond allocation in your portfolio. So let's take a look at the computer and I'll show you exactly what I'm talking about.
So we're going to look at a specific case today that's just a fabulous illustration of the wholesale income advantage. I've got our inventory open and I've sorted to bring some of these really high yield cases up to the top. And this is the this AIG case is the one that really caught my eye. You know, when you select these cases, or when you see a case online, you can always select it and combine multiple cases if you wanted to on this little side tab. But you can also just open it and pull down illustrations, payments table, and a reservation form here. And that's just a quick side note. There's other videos about how to operate and look through the inventory, but let's just look at this one in particular. So I'm just going to select it and put it on the clipboard. And what I'm going to do is come over to this little tool that we have. And this tool is available for your download in Microsoft Excel if you want to use it as well. But it's a great way to look at the wholesale income advantage strategy with one specific case in mind. To recap, the wholesale income strategy just really looks at your portfolio or a section of your portfolio and says, all right, how much better am I going to do by buying this fixed income stream and leaving the rest left over and invested for growth instead of a 60-40 traditional kind of Wall Street cookie cutter allocation. You know, you'll see ads for Ken Fisher, for example. It says, you know, don't buy an annuity, and if you have more than $500,000, come talk to me. Well, that's what they're going to do. They're going to try to put you in a 60-40 stock and bond allocation, tell you to do a safe withdrawal rate that maybe is 4% a year of your assets, and sort of hope for the best, and charge you a point and a half, maybe 2 points a year in fees. I'm going to just show you right now numerically how you could just do a lot better doing this yourself with a fixed income stream. And the reason it works so much better right now is that interest rates are unbelievably good. We've gone up precipitously in interest rates in the last 18 months or so. And the 10-year Treasury is an indication of that. We'll take a look at it. And so this 10-year Treasury chart shows you, in 2005-06, we were at 5%, and here we are, 2023, we're almost there again. Historically speaking, the Treasury has come way down over my lifetime in business since about 1995 or so. It's come way down and it's marched way back up again in very recent times. Because of this, and this has been hell on savers, there's been no money in fixed income for a long time, but it's significantly better. And so now we're in a situation where fixed income yields exceed the long-term, my fixed income yields exceed long-term bonds, and they exceed the yields available, or they're really getting close to yields available in the overall marketplace, in the stock market. So it's a situation where you can buy a fixed income and get yourself out of the roller coaster from markets and let your remaining assets stay invested for growth over the long term, because it's the long term in the markets that really will provide, that give you room to recover. If you're not buying groceries with your stock market portfolio in a down market, your portfolio lasts a lot longer. And that's kind of the fundamental reality of dollar cost averaging or reverse dollar cost averaging if you're buying when the market is down for retirement income. So the major forces at work here are great long-term interest rates that allow you to stay invested for growth longer with a safer overall portfolio allocation. So let's look at one specific case that illustrates this. There'll be other videos I'll illustrate other cases, but this particular one that I like is this AIG 6.25 yield, $378,000 purchase price. So it pays $1,600 a month, increasing 3% a year, lasts for 30 years. So let's say you have a $500,000 portfolio and you want to pull $1,600 a month out of it. That's $19,200 a year. That's right close to that safe withdrawal rate that I mentioned, that 4% This is 3.84. So this is not an unreasonable sort of series of assumption. Let's look at what happens, just assuming you put that into the market with your traditional Wall Street money manager. This is pre-tax and pre-fees. Just going to look at it on a gross basis. We use this free tool. You can use it as well. That is a portfolio visualizer, and it runs 1,000 different, maybe even 10,000. Yeah, 10,000 different simulations of how a portfolio is going to perform at various different market times and market performances in the past. That's what Monte Carlo analysis does. It just looks at past performance and says, it runs all these different scenarios over different times to give you an idea of if you had done this particular, whatever hypothetical allocation you want to do. If you'd done it over time, these are the different ways that it would play out. So the inputs are really pretty straightforward. $500,000 investment. We're going to withdraw $1,600 a month for 30 years. And I'm trying to set up a really good apples to apples comparison here. We're going to let inflation go at 3%. There's different ways you can run inflation. You can run it on historical, which will run higher and lower, or you can just run it at an even 3%. 3% works. And then for assets, there's different ways you can do it. You can run just on asset classes in this tool and say just U.S. stock market, or U.S. or U.S. bonds, or you can use specific tickers. So you can run this tool any way you want. I'm going to use a couple of specific tickers: a Vanguard bond fund and a Vanguard stock fund, and you can see those two right here. This VFINX. Now, I'm not a stock advisor. I'm not telling you to buy this stock at all. Let's make sure that's quite clear. This is just a proxy for the U.S. stock market, the S&P 500. Vanguard makes all this information available. There's a very low expense ratio on it here. They show you, the fund's performance against its benchmark being the S&P 500. So over 10 years, this thing has averaged 11.7 a year. It's a great rate of return, but that's basically what the market has done in this same time period. Bond fund, same thing. All the information's available here. Very low fee structure. So this is a good proxy for bonds. This is a good proxy for stocks in general. So we're going to put these two things in here: VFINX, Vanguard 500 Index, and VBTIX. We're going to say 60% in the stock market, 40% in the bond market. So we're going to just run, this is as close as you can get to a 60-40 cookie cutter Wall Street kind of approach to managing your money with $500,000 and pulling roughly 4% a year out, with increasing over time. That 3% inflation applies to your income as well as to the portfolio. So what happens over time? The worst percentage is you lose everything. It doesn't survive. That's called portfolio failure or ruin. In the lowest 10 percentile, that withdrawal rate exceeds the safe withdrawal, and you're out. That's this purple line down on the bottom. It has gone to zero. In the middle section, you've got 200,000 or 500,000 left over at the end of your run. And in the best case scenario, you got 4.5 million left over. So for this purpose, we're going to just use this number here. Now, every time you run this illustration, that number is going to be a little bit different because it's assuming different time periods and different events using historical data. Now, this time it's 14460,900. Run it again. It's going to be slightly different. So your mileage is going to vary depending on when you do this and what tools you use. But again, the point here is just to look at an apples to apples comparison. So I'm going to put that number in here at the end in the 50th percentile, right in the median, middle of the road. you could have 1.4 million left over after pulling $1,600 a month for 30 years off of your $500,000 portfolio. That would be a great outcome. Now let's compare it though. Let's just compare it to what happens if instead of pulling $1,600 a month off of that portfolio and that portfolio going up and down and you facing the risk of total portfolio ruin or running out of money. Let's just look at it a different way. Let's say you pay $378,730 for this exact same income stream, $1,600 a month for 30 years, going up 3% a year. Guaranteed, AIG making the payment. You're left over with $121,270. So let's go back over here, and I'm going to change just two things. I'm going to say, all right, instead of investing $500,000 in a 60/40, I'm going to invest $121,270 with no withdrawals, same inflation. I'm going to put 100% of it in the market because I don't need a safe allocation because I just bought all my income that I'm going to need. Now, what do you think that's going to do? You've got way less money to start with, $121,000 instead of $500. Run the simulation. Well, the first thing to pay attention to is the worst case scenario. You never run the risk of running out of money. But let's check out the 50th percentile. This is the nominal number, is the one we looked at in the other. Oh, 2.8 million. If I recall right, that's a little bit more than 1.4. In fact, it's 94% more. So this is the big aha moment. Same $500,000 that you started with, same $1,600 a month that you're pulling out, same 3% a year inflation, starting at 378 for this contract and 121 in the market instead of putting all 500 in the market, you can end up with 2.8 and no chance of ever running out of money. So 94% more money at the end of a 30-year run by using fixed income. I said in my presentation earlier that you've watched, up to 51% more money. We really had to sandbag the numbers down because 51% is incredible. 94 sounds unbelievable. It didn't sound credible. Every single time I run this illustration, the numbers are 50, 60, 80, 100+% more total output when you compare using a wholesale income contract to Wall Street's kind of typical 60/40. Same income withdrawals, same inflation, same ticker symbols. It just works every single time. It works better all the time to use this. I hope this helps look at it on a specific case with a specific set of math. You can do this. Your results will vary somewhat based on whatever you choose. You may use different stock ETFs or market proxies, different bond ETFs. But the fundamental reality is this works, and I hope you like it. So my name is Nathaniel with Wholesale Income, and I look forward to speaking with you. Give me a call, and we'll see if we can put something like this together for you.